All right, good morning, everybody. Yesterday afternoon, statements were made to imply we're ahead of schedule with the war efforts and signaled that perhaps there might be some G7 release of the strategic petroleum reserves. So today, there's going to be a meeting with the French energy minister and the U.S. They're going to focus on perhaps releasing some energy. This is going to the heart of the price paid at the pump. So, it's only that, right? It's just trying to normalize price a little bit because everybody started pricing in higher fuel costs even before they had to pay those costs themselves. And so this is just trying to back that off a little bit. As for whether or not they're going to be able to resolve conflict quickly, I mean, they can say what they want, but the analogy I used yesterday is they kicked a hornet's nest, and you can say you're willing to call it quits and end conflict, but maybe the hornets have a different take on the thing, right? So it's not like you just say sorry and they all just go back in their home. Who knows? We'll have to see how it plays out, but the market certainly respond well yesterday. Got that push to the upside yesterday afternoon. Add that to the Strategic Petroleum Reserve meeting today, we could see another boost to the upside if the meeting goes well. It doesn't have a time frame listed here, so hunt around to see if you find headlines somewhere. It's not listed here either. Just be mindful, nothing has changed yet. Just positive talk. And, positive talk only gets so far. Small caps down around 0.5%. Dow, S&P, and the Nasdaq are basically flat. Japan looks really good, up more than 1.25. Europe almost 2.25. So it's looking good out there to a point. We just have to keep that focus, right? That nothing has changed yet. We have another auction today. This again is not one of the big ones, just a 3-year. It's up front, it's close. You could continue to use IRX likely in this scenario. So I never discount data. If there's something coming out, I want to keep my eye on it, but this is not one that generally causes big movement. So we'll see how that goes. We are going to get some employment data today. That has a history of causing some drama, so keep your eye on that. I was looking over the FedWatch tool this morning, and we're still sitting way out in September and October, but it does seem like things have backed off a little bit, but we're not seeing it brought around to the front end. So, July, it seems maybe starting to pick up, or let's say it another way, starting starting to pick up that they're going to pass, right? That it's going to be higher for longer still. You can see our current position, the likelihood that they don't cut and that we stay where we have been. Well, that did dial back a little bit. We were at 47 and now we're at 41.5, and the chances of a rate cut went from 41 up to 43. But these are very small changes. We would want to see significant repricing in this, and we're not seeing it yet. So little shifts, kind of like just waves on the lake, right? Not really big, just moving a little bit, and that's normal. Just keep your eye on it. If the markets start to significantly reprice the Fed's position on rate cuts, then we're going to see moves like we had yesterday afternoon, but it doesn't necessarily have to go up, right? It depends on what the market starts to price in. Why it decided to log me out. We'll get logged back in. The threat from the White House today is the lowest I've ever seen it. It's at 10. We'll get logged back in here and see that. So White House risk really low. Now we all know if there's any chance that he can talk to reporters, um, just get to rambling, maybe they get him with a gotcha question or something. There's always the potential for something to come out of the White House, but for the moment it's sitting at a 10, so really don't need to look in that direction. I would continue to look at market breadth, treasuries, commodities, volatility. Keep your eye in that direction. So we're dancing around the volatility trigger and the zero gamma line. We tagged the 10-day moving average. We're still underneath the 10-week moving average. We're back above the 200, which is down here. So we've got the 50 up here with the 20, the 10. We're back above the 3. We're getting into this pinch scenario where the market's going to start to get pinched between the 50 and the 200. We had a gap down Monday. It was fun. I was talking to somebody about this yesterday who hadn't really caught on to this before. It's been around for a long time, and this is not a logic that I came across or that I developed. I found it like everybody else. A gap down Monday generally turns out with an upside move, right? But it depends on where you gap from. If this was a gap down Monday from the highs, it's likely we would have had a different outcome, right? There's different kind of gaps: exhaustion gaps, breakaway gaps, earnings gaps. If you haven't done any gap research yet, it's worth the effort to pick it up to learn it. So a gap down with a big wick bar, especially into a solid level or a key level, a major moving average, anything like that that can help flip it over. It's worth learning this pattern, this setup. So right now, this move up is what we want to focus on. Been keeping track of these lower highs, and right now, we're still waiting for what that's going to look like. So we've had our move down. We're on our way back up. Are we going to get hung up around 6,900 or 6,950? or will we be able to make it back to the previous high and set an equal high or a new high? And that's kind of what we're stuck on at the moment, is getting that equal high or that new high. And it's a tall order because we've got a lot of trash to get through. Not only all of our moving averages other than the 200, but those key levels 6,900, 6,950. And if we try to make that run before OPEX, we've got all of those OPEX levels that we could hit. So right overhead at 6,800, that would still be in negative gamma. But once we get across 6,900, 6,950, 7,000, it's very likely that we're not going to be able to make that shift unless they start to roll out in front of OPEX. It's the third Friday of the month, so we're talking about next week. I don't think the market's going to wait that long. It's either going to start to roll out early or we're not going to make the move yet. Otherwise, I just think there's too much drama here to be able to make that. Now on the SPX, there's 6,950. That would give us the equal high that we're looking for, or the new high. So 6,800, 6,850, 69, and then 6,950. We got a gap close that we have to deal with on the SPX. It's from Thursday's close. So if we continue this push to the upside today, 68.32 cog line on the SPX is a gap close. So that's what we're focused on. Is this a rally into resistance before we roll over, break lows, and set new lows? Or is this the recovery off of the lows where we run back up, challenge previous highs into all-time highs, and finally start to get out of this box that we've been in for months? I don't know. Nobody else does either, right? It's not in my nature to try to run the crystal ball. 173,000 in the overnight. The average is around 50 something. So sitting at plus 170, that's a bit much, right? So we still have a lot of participation. And if you look at what that participation got last night, we got nothing. We haven't gone anywhere. We didn't accomplish anything. We're flat on the morning, like a hamster on a wheel, doing a whole lot of running around, but we're not getting anywhere. We did get that gap closed yesterday. That worked out really well. That's a part of the logic of a gap down Monday, right? So when we was working our way to the upside, the entire time, my thought was we're only going up to get that gap closed. Whether we continue to go up after that, we'll have to rely on something else. But we were only going up to get the gap closed. And that logic was holding really good until the news came out. And then, of course, none of that mattered anymore. That's an actual physical gap in price. This is a liquidity gap that I think we might want to keep on the radar. It's where the news came out that sparked this shot to the upside. And as far as I'm concerned, it's the same kind of liquidity gap that we would get on CPI, PPI, non-farm payrolls, one of those, right? So mark that level out, carry it forward from here on out. And you know what? Hey, if we never go back down there, fine. I guess it won't matter. But if we get to moving in that direction, I think that level, I think we'll fill it if we get back down into it. Oh, yeah, this week? No, I agree with you. I don't think it's going to be this week because of OPEX, right? We got the bumper rails in place, those bowling rails. So, you know the old phrase, going off the rails? I don't think we're going off the rails. Not this week. So I agree with you and your Magic 8 Ball. So keep your eye on that 67.22 area. Keep it marked. I think it's worth carrying it forward. Now we got the midpoint of the RTH of yesterday, and that's really close too, right? Maybe carry that as a zone. And then we've got all of yesterday, and that's 6,700. Don't really need to mark it again. 6,700 is already a key level. What I just measured out here is yesterday's RTH with the 111 and the 1236, and there's our 111 reversal. We didn't quite get there, but that's all right because when breakouts fail, we don't always even get into the 11. But it shows us how far we could push on the breakout before the breakout fails. Whether it fails early isn't really relevant. It's just giving us a temperature or a gauge of how far price should go or could go before the failure. Now we're on the pullback. We got the 786. So if we're gauging this pullback to see how far it should pull back before we continue to move to the upside, that's as far as it should pull back. If we get below the 786, then it offers the half. It doesn't mean we're going to go to the half, but it opens the door. We got these levels here. We got to get through that. Got the ADR half, which we haven't gotten into yet today. So if we break our Globex low, let's challenge that ADR half, get through that. We get this liquidity gap filled. Maybe we overshoot and we get into the full ADR. After that, RTH low, and then yesterday's full low. I'm not seeing any reason that we should retrace all of this unless some new headline comes out, right? Like the warm and fuzzy feeling we got yesterday so far seems to be holding. We could hear something from the strategic petroleum decision. You know, maybe it's not as positive as the market wants. That could do it. The ADP data this morning could possibly have some influence, but other than that, it's going to have to be some gotcha surprise headline that isn't a part of the economic calendar. It is worth noting that we had that inside day breakout this morning and we wasn't able to keep it. So on this pullback, we really don't want to see the pullback get back below that 786 after having achieved a breakout that failed. it does imply, if we do that, more weakness. So we want to hold the line. Definitely want to keep the Globex low that we've already got. We don't want to get any deeper than that. And I keep looking for like a hurry up and wait scenario. And so far, we don't have one. So we're holding the line, but for what, right? There's nothing that we can look forward to say, yeah, we're waiting on what? CPI, PPI, non-farm payroll. Well, we're not waiting on any of those. OPEX is too far away, so we're not waiting on that. I don't know. All right, we are challenging the weekly floor pivot right now, 67.92 cog line. Today's floor pivot is lower than yesterday's. That's bearish. Price opened above it. That's bullish. So far, we have a MDP. We had one yesterday until the news came out and shot us up into it. Now we're above it, and we haven't even gotten inside of the floor pivot channel yet. So I want to keep our eye on this weekly floor pivot. If we break that, we'll re-challenge the low and get inside of the regular floor pivot channel. And if we continue to fade, we've got 67.32 cog line, which is today's floor pivot. It's a relatively wide box. Wide box or wide channels imply that if we break out, it doesn't stick. We did break out. It didn't stick. We came back in again, but we could try it multiple times. As long as we're above the weekly pivot, we're more in a bullish bias and we're bearish below. But that's more of posture than positioning. This MDP won't count until tomorrow. We have to get all day today without hitting this pivot. So far, so good. If we was looking to count missed pivots, starting that count after a reversal off of the lows is a really good place to start that count, right? If we're looking to come back up off of this low, then counting these missed daily pivots on our way back up is exactly how we want to do it. But so far, we have positioned for one, but we don't even have one yet, right? We got to get it all started. 68.80 is R1. It's a long ways off. You know, it might be hiding in there too. S1, if it's not, then we're really imbalanced. On to, where's number 3? There's 3. Okay, it's really imbalanced. This is what I'm referring to. Here's the floor pivot. Here's S1. It's 1.3, right? Maybe I missed it by a tiny bit down here, but it's close enough. 1.3. You can see how far away we are from R1. They're not balanced. R1 is a lot farther away than S1. This indicator is giving us the path of least resistance, and it's showing that there's more room to the upside than there is to the downside. Just keep in mind this indicator doesn't make price do anything. It won't make us go up. It won't stop us from going up or down. It's just giving us some insight on how far we could travel before we hit R1 or resistance 1, and how far we could fall before we hit S1 or support 1. Usually they're a lot closer together, right? Like back here, distance from floor pivot to S1 versus the distance to R1. It's not really that far off. This is significant. All right, last week's point of control around 6832 cog line. Remember, this is more about a zone than it is a line in the sand. We put in a lot of work across that level here. That's what we have to watch if we're going to be able to continue this move to the upside. We've got to get through this. That's a lot to work through. You should be able to see it in the dome if they're defending this level, pulling and stacking, see if it thickens up around that zone. See if they're even spoofing it at all, right? Because technically they're not supposed to do that, but we all know they do it anyways. And if we can get through that level, then we've still got another zone up here. Yeah, but I don't know that tomorrow's CPI is really going to carry anything. We haven't seen it so far, right? Usually we'd be seeing behavior, and we're not even seeing it. So, like I said before, I won't discount data. I won't ignore that CPI is coming, but we're not seeing a hurry up and wait mode for CPI yet. It is worth keeping it on the radar. So within our own zone, we've got a distribution that we're messing with right now. Getting through that, it gets thin, brings us back down to the point of control on the week, which is this lower distribution. That's a lot of structure to work through. We'll see if they defend it if we come down into that zone, but we'd have to get down there first, right? So 6832 has a lot of relevance right now, especially with last week, and it's a cog line. $10-day, 30-minute volume profile and TPO. The TPO looks pretty good, all things considered. Most of the work is within the value area. The volume profile, it's still pretty ugly, all things considered. Point of control is still over our head. We're close enough to it that it could begin to act like gravity and just bring us up into it. By the end of the week, we should be done with anything above 6,900. So just kind of slide that over a little bit. You get a preview of what it looks like. 6920, I guess that's the 6910. It's kind of the high end up there. But that's if we don't get back up there and leave some footprints behind. So we've got a really nice reversal started. We just need to classify whether or not we're done. And if we're starting to turn this around and work our way up, or if this is just a bigger pullback than some of these other pullbacks that we've been getting. All right, we cut through that March 6 VPOC. We're done with that. But we did build a new one for the 9th. So we'll just steal that line, bring it down here. I'm not going to zoom in and get to the tick perfect. I'm just focused on the bigger number, the point. So that's good enough for me. If we break Globex low. I want to target 6,700, but that VPOC could get in the way, slow us down. You can see this morning our point of control is lining up really well with the distribution point from yesterday afternoon. So they're putting in a lot of work up here. It's possible that we could see the rest of the day sitting in this zone, hanging out between the ADRs and just not getting anything done. It's possible because we don't have anything else on the table today other than that strategic release, right? The possibility of strategic release. How much they release, if they're going to release any at all, when's it going to hit the markets, and then is it going to be enough to get everybody to reprice with what they're already putting out at the pumps? That's a lot of ifs. As deep as it seemed we fell yesterday, we didn't hit the edge of the weekly expected move. Right? This helps provide some context on how far we fell yesterday, because I was talking to a couple people who seemed to really get bared up, right, yesterday before the rally back, right? They're just concerned about how bearish it was out there. Well, when you look at it from this point of view, it doesn't really feel that bearish, right? We went as low as we were supposed to go, and that's it. We turned around and we started working our way back up. So it really doesn't feel that bad, or it doesn't seem that bad. When you look at how far we were supposed to go on the whole week, and we haven't tagged that. Now, granted, that's the level for the whole week. So, by Friday, we're supposed to be able to reach the edge, either green or red. And we was able to get really close to that edge in a single day. So we made, wide swings, but we didn't breach the level. We're still hanging out inside of Friday's bar, just like the bar from Cheers, right? So we got to get out of that. Friday's range is what we want to focus on. You could focus on yesterday as well, but yesterday's bar is so big that I don't think it's going to provide any value, right? It's just too big. So work on Friday's level. It's got enough that we can work with, right? The midpoint, the open, and the high of Friday. And then all of last week, every time we got up into this zone last week, we were rejected around that 6,900, right? 68.92, 6,900. We wasn't able to get through this zone at all. So if we can get out of Friday's level, that's the goal or the target. But be ready to flip that thing over once we get in there, in case we do get rejected again. Unless or until we set that lower high, we do not have an answer yet, right? There's the high, lower, lower, question mark. We don't have an answer yet. We don't count this. That wasn't a lower high. And even if you did, we're still a long ways off from that too, right? I'm not going to count it, but you can. So we don't have an answer yet. We would need to fall away from the high that we're at here, this like 68.20 zone. Leave it behind clearly and cleanly, and then look back and point that out as a lower high. So as far as we know, this is just a bounce into resistance, and it's going to roll over and retest the low and set an equal low, or worse, a lower low. We just don't know yet. That's the point. We're still below the 10-day, hanging out near it. We're not down more than 1% to the downside. We managed to get back above that negative 1%. So we're just sitting in that collar that I talk about, -1 to 1 and from half to half, right? Two different collars there. When we're in this zone, we're not overbought or oversold. We're not overextended. We haven't moved too far, too fast, and it doesn't owe us any move in any direction. We get outside of that, then we got to reevaluate. You can see when we got outside of that -1%, we whipped back the other direction. Back here, we went the other direction. Here. So if we get more than 1% away from the 10, we have to have sustained negative news to keep us down there, or we're very likely just going to flip over and come back. But we're still hanging out in this zone. So we've got room to the upside, we got room to the downside. Path of least resistance is up. Looking at the 10-week, around 1% below the 10-week. I keep looking for my crossover, and we still aren't getting it. Right, this crossover we've been looking for half a year. Getting a little expansion to the downside here. Some of the best moves to the upside started first with moves to the downside. So we'll see what comes out of it. I'm not really all that heartbroken over this move below the 10. It's lasted a bit longer than I would have liked, right? These quick dips down and recoveries back up certainly play out better. Now that we're below this, we could get stuck down here for an extended period of time, like we have, in the past. Keep your eye on the -2% level. You can do that just by looking at where your 10-week is and where price is, and then just use your measuring tool. As long as we're moving back towards the 10-week, everything is fine. If we turn around and start moving lower, farther away from the 10-week, then we got to keep track of how far away we're getting from it so that we don't get into some levels of overextended positioning can shoot us back, right? Mean reversion. This, it's extreme, but the example fits. You get too far away from the 10, you're coming back the other direction, right? We're not even close to that. Looking at what's down the day, it still seems like a really long list, but the benchmark that we use is 0.5%. And once we apply that, we really don't have very much that meets our criteria. SMH, XLE, so we got chips and generic energy, bonds. Really, that's about it. Looking at what's up this morning. What's uranium, China, China again, nat gas, VIX, Bitcoin, China again. Bitcoin is a nice representation of risk. It's like the poster child for risk. So seeing that up, that's good, but that's not enough. Just because they're willing to take risk doesn't mean they're going to take it. So we don't have a broad market breadth this morning. We'd want to see consumer discretionary, some Mag 7s in there. Chips is a good start. It's just not going to get it done by itself. Now, once we get into the open, we could see that rising tide, see that that market breadth kind of lift all boats. We can't see that in the pre-market with options, but we could see it if they were going in with shares and pushing those names around. We're not seeing that. A reduction in volatility could boost us, give us some help to the upside. Moves within the dollar, oil. So we want to just continue to look around at the other markets. Remember, it doesn't matter what you're trading. ES, NASDAQ, SPY, the Qs. I don't care what you're trading. Don't just sit there and stare at that one chart that you're trading. Continue to cycle through the other charts, looking at what's going on out there. All you're looking for is outliers, something that stands out. If there's nothing there, then there's nothing there, but at least you looked, because I guarantee you, if you don't look, you're not going to see anything, right? So it wouldn't matter. It's not a scan, it's my own personal list. I'll share it. I'm more than happy to share it. Depending on the platform you use, you might not get every name in this list, right? Like if you're looking at TradingView or something versus Thinkorswim, you might not get all of the names, but they're not all needed, right? And a lot of them are redundant. So there's some in here like growth versus value, SPY growth, SPY value. You don't need that stuff, right? The bond volatility index doesn't update every day. You don't need that in the list. So I'll share the list. Just it's what I've built over the years. I like it. I look at it through the day. Some of this doesn't even respond in the pre-market. It only works during the day. So, but they're all designed to give us a snapshot of some piece of the market. Once you've looked at the basket of stocks, ETFs, ETNs, indexes, then you look at the individual stocks. Thinkorswim really doesn't do that great with the individual stocks. So if you want to go that route, use the scanner somewhere else. I mean, don't get me wrong, Thinkorswim can do it, but I would rather do it, say, on TradingView, and I use the S&P 100 and the NASDAQ 100, and now we're looking at actual stocks. So that if I am looking for market breadth, I can quantify that with a value. 28% of the S&P 100 is down 0.5%. One name in the S&P is up 0.5%. Woo, that's some heavy stuff there. NASDAQ, 8% is up 0.5%. 25% is down 0.5%. So yeah, not a scanner, just a homemade list of various ETFs, ETNs, some ratios, trying to get a feel for what's moving out there. Because that's what we want to focus on, right? Markets aren't going to move by themselves. They're influenced by something. As for the pivot question, hit me up in the chat. The cogs are all mine that I picked up from somewhere else. It's very complex, old school. And for regular pivots, we got a lot of material on it. Just hit me in the chat. That's what I got, guys. Be careful, be safe, watch the clock. Remember what we got to deal with today, right? It's always the same thing. Get out of the box. Right now, the box we have is our own Globex range, and to the upside, that's it. We can expand and run. To the downside, if we get out of this Globex range, we got to work our way down through all of this stuff, starting with this liquidity gap right there. I want that gap. If we break this low, that's my target. Then the RTH open, RTH low, and yesterday's low. Level by level, run it all the way down. But that gap comes first. That's what I got, guys. I'll see you tomorrow.